Welcome to both our MSF audience and our MSREs. We've been looking forward at least a year to getting Charlie Toppino to visit us here. I will let him give you some clues about the breadth and depth of his experience. I'll give you a quick rundown. He's currently president of Oak Pass Capital Management, which he formed, which invests in high-yield commercial mortgages and real estate assets, working with institutional partners. They deal with commercial, multifamily, and hospitality, just to keep it really interesting. They have something like 90 assets at the present time, about $1.2 billion, that's with a B, of assets at this time. Charlie's a former senior principal in Square Mile Capital Management prior to forming his latest firm. And before that, he was, that firm invested in real estate equity and B notes, residual notes, and distressed debt, which is got to be an interesting challenge. And before that, he was co-founder of Secured Capital Corporation back in 1990, which eventually merged with Eastdil. Now, some of the handouts he's given you will show you who Eastdil is if you, like me, have not had rubbed shoulders with them much. They're incredibly important. And his firm merged with them, and in 2006 they became, I believe, a substitute. No, they merged in 2006, and they're now a subsidiary of Wells Fargo. Charlie also has founded firms in Japan and France. He's a bachelor in accounting from our school, and he's also, we're delighted to say, a member of our chairman's circle of our advisory board for the Bergstrom Real Estate Center. Charlie, we're delighted to have you here.
Thank you. Well, thank you guys for having me. The header up here is what happened and what's next, and I was kind of thinking about it is if you guys were undergrad for 4 years and a master's for 5, you might have missed this whole presentation, and we'll kind of tell you what happened while you guys were in school. We're going to cover, we're going to discuss the build-up, the real estate market built up to 2007, tremendous amount of flows, capital markets. In the first section is going to talk about how we got to an overheated real estate market. The second thing we're going to try to cover and discuss is why it took so long for the recovery, which we call the resurrection from the dead. And then we'll also talk a little bit about where I think the capital markets and the real estate equity markets are today. Then I thought I would, there's a handout, there's a one-page handout that I had that kind of lists U.S. real estate advisors, who's really out there on the advisory side. You guys should know who they are. It's a good place from a perspective of really understanding real estate, a place maybe if you worked at, I think you get a broad exposure to the equity side of the market, the capital market side of the market. All two of those are really intertwined, and that's what drives the commercial real estate market. And then the last thing we're going to take a look at is an investment opportunity that I chased, which was a pool of assets 10 months ago, 12 months ago, and why we liked the deal, how we looked at it, how we arranged capital to do the deal, and how we underwrote it. And unfortunately, we didn't acquire it. We were second best bidder on it. So it's been somewhat of the last 2 years have been extremely busy, but a very competitive market. I think Dr. Archer talked about me acquiring 90 properties for $1.8 billion. That's actually the amount of deals that I chased over the last 18 months. We've acquired about $300 million worth of assets. But that's kind of the volume of deals that we went after, we raised capital for, we underwrote, and unfortunately we were second on $1.8 billion of assets, so it was painful. It's like a painful event. Let's talk about, try to move through this. Why, you kind of take a look at the real estate market. In 1990, we had the RTC, the last major real estate recession that occurred was in 1990. And that was a buildup of a lot of S&L problems and government regulation problems that created that overheated market. But in 1990, RTC was formed, major transfer of ownership of real estate and wealth at that point. And it took the U.S. market from 90 to 95 to really recover. And in 1995 is when the U.S. REIT market really rebounded. And that's kind of where I would say real estate started its uptrend. And that's where the market started growing and started being fashionable back in real estate. People could make money in real estate. And if you kind of take a look at it, so from 1995 to 2007 was a bull run. So we're talking here, it's a long bull run. What fueled it? And what fueled it is low interest rates, low rate, the cost of borrowers to borrow got extremely low. There was a premium for real estate because people used to believe that real estate was an illiquid market. And all of a sudden, 95, REITs started trading. There was a public market, stocks. You could buy real estate by owning a stock. It started to feel like it was a liquid asset. In reality, real estate's not liquid. It's harder to sell. So there was no premium for investing in real estate. People started looking at real estate as being not that volatile. It was an asset class that was more stable. And in reality, if you go into a recession, the economy's bad, we'll get into how bad the market can change in real estate. So there really was a limited amount of volatility. People thought it was stabilized. Also, what happens when you get in a overheated market, all of a sudden, your underwriting standards start becoming much more loose. And when underwriting standards get looser, bad things happen. It's kind of like the police officer that's buying a $300,000 house with no docs, with underwriting that required no documentation. It just, you shouldn't be, the underwriting didn't work, and that's what happened on the commercial side as well. And then all of a sudden, typically people used to get, on commercial real estate, you used to be able to finance, maximum financing would be 65% of the value of the asset. We'll kind of get into that. The amount of leverage you could get on commercial real estate went through the roof. So those were the things that really created the downturn of what happened in the market, but that's what created this tremendous volume and increase in volume that occurred in the U.S. real estate market. Then what happened is when we came to the crash, all of a sudden liquidity got drawn out of the market. Basically, the financial institutions and the lending market dried up and their balance sheets were constrained, so there was no liquidity to support the real estate market. If you kind of take a look at this graph, which will show you over what I would call the bull market, which would be 2002. Basically in 2000, 2001, we basically had the tech correction. Everybody was buying tech stocks, and it was going crazy, and then it crashed, and it kind of rebounded. It took about 12 months for the market to rebound. In 2002, all of a sudden, the equity markets and the investment markets took off, and if you kind of take a look at it, the REIT market, on an annual basis, annual compounded return, if you were investing in REITs, you were making 26%. If you were investing in emerging markets, 25%. If you were invested in the S&P 500, you were averaging almost a 7% return. That was an unbelievable time to be in the market investing. That helped drive this sense of no volatility in the market. We can only make money. Real estate only goes up. Stocks only go up. And we all know by being around long enough and watching history, cycles happen. This is pretty interesting. We talk about how the underwriting standards changed. Back in 2002, that's kind of when the commercial securitization market really kicked off. And if you take a look at it, there was only, there'll be another graph here that'll kind of tell you where the volumes went. But back then there was, loans would get made. If you buy a house, it's an amortizing loan, and the loan gets paid down over time. So back in the early 2000s, 11% of the loans that were originated were interest only, meaning there was never any amortization. If you kind of take a look at it, it just goes up every year to 2007 to when 86% of the loans that were originated had no amortization. You kind of look at where, so you could, it clearly is identifying that the underwriting standards were getting worse and worse and worse every year that went by. Again, this is a typical CMBS loan. And up until about, again, early 2000s, and historically behind that, you bought a piece of commercial property and you could get financing of 60, 65%. If you kind of look at this stack, you were able to get finance. There would be a preferred equity piece, which was a 10% slug. Then you could finance a CMBS loan to about 70, 75%, and you could get a mezzanine component. And at the end of the day, the actual developer, real estate owner, had at maximum 10% equity in the deal. I mean, he didn't have that much skin in the game. And within a couple of years, I have interest-only loans. I'm pulling cash out. All of a sudden, over a couple of years, I pulled my 10% out. I got no money in the game. Only the lenders or the bondholders have the risk. So that means guys will take more. Developers, the first thing. If you loan them money, they'll spend it. You know, same thing in the real estate thing. If I can get my equity out and I don't have any risk, I'll do riskier things. So this is 2007. A typical deal was getting financed up to 90%. Worse than that, if you take a look at a typical financing, to the left is call it a 75% loan. The AAA piece is 45% of the loan, and what you're doing is you're taking a $100 million loan and you're cutting it up into slices, and the red piece is the most risky piece. The first loss is the guy on the bottom, but he gets paid the highest return. So, you know, the guy on the top is probably earning 5%. The guy on the bottom is probably earning 12% on that financing because they've cut it up. What happened in the marketplace is, number one, we were loaning the borrower too much money off the bat, but then we could also, on the right side, the guy over here, the triple B piece, which is only 5% of the loan, could go out and put a bunch of those security, the non-rated pieces, he could aggregate a bunch and re-securitize it. And therefore, he was able to, take a look, it's 23 to 1, it's 27 to 1 leverage. So theoretically, it's like a 3% equity. He invested 5, but he really pulled out another 2. He only has he's got a couple pennies invested in that deal. So it's further leveraging an over-levered piece of paper. That's kind of where we kind of got into these CDO. This is what's known as a CDO, and you kind of talk about, what in the financial markets, you were able to create these structures that by plowing many, many different issues in, gave everybody the sense that you had diversification, therefore there was no risk. But in reality, it was so levered that the market didn't have to move very much to actually hit you. And a matter of fact, the AAA pieces, we'll talk about that, they actually got hurt. Mathematically, it was like there's no way the market could ever absorb that much pain that they could ever pierce the AAA, and in the commercial market, it did. And up to that point, it was theoretical that it couldn't happen. Yeah. Yeah, it's probably double a triple B. It's probably, it's definitely in the it's definitely in the triple B class or lower. I mean, you got a nice. Again, it was a on a quality, yeah. That was a rating agency mistake, I think. Again, by diversification. We got 300 assets in here. It's unlikely that they're all going to default at the same time. This is kind of interesting also, and when the first securitizations came out, the subordination level is the amount that is not part of the securitization that basically somebody else has to hold. And in the 2000, 2001, 2003, 20% was kind of the, we did a 70% loan, somebody other than the securitized piece would have to hold the non-rated piece, and they would require 20% of that loan to be held by that. And if you kind of look over that time period, it dropped down to 12%. So you can kind of just see, again, further deterioration of the underwriting quality, as well as this is people talk about the rating agencies, lack of monitoring the system. They set this. This is definitely a rating agency issue.
Potential to rate this paper was an unprecedented growth opportunity for the rating agencies in getting away from corporate bonds.
Maybe my feeling in life is people aren't bad people. I think one individual may be a bad person, but in reality, I think mindset was where there's this paradigm. Real estate now all of a sudden is a global market. we're doing all this securitization. The transparency of information is so great. I think people just got caught up in a change in the world, and they believed it. You know, I also think, though, realistically, economically, rating agencies that got the business got paid for it, and the guys that wouldn't do this didn't get paid for it. So I'm sure it's a combination of both. I think in general, I don't think people went to work every day and said, hey, I know eventually it's going to blow up, but you know, I'm going to make money. But I think there's clearly a combination playing off of it. So, okay, kind of walked you through how we got to 2007. What happened in 2007? You know, here's what happened on transactions. These are transactions that occurred that were greater than 25 million. So in 2003, the U.S. market's pretty healthy, and there's $75 billion worth of transactions that are happening. I mean, it's a vibrant market. It's clearly healthy. Okay, now take a look at it. By 2007, 5-time multiple growth of transaction flows. I mean, that's huge. Here's another thing. If you take a look at the CMBS market, again, the CMBS market really got started about 2002, 2001, 2002. Kind of take a look at 2003, 2004, started picking up. By 2007, it was doing $230 billion worth of financing. Take a look at that, $600 billion. The majority of it's interest only, high leverage, low debt coverage. We got a problem going on. Let's see if I can catch up to my notes here, other than I haven't looked at them. Here's what happened in the single-family market. You kind of take a look at, you know, the subprime back in the second quarter of 2005 was about a 10% delinquency. It spiked up to 24%. If you take a look at, so these are single-family. You can kind of start seeing delinquencies. They're starting to move unbelievably quick in 2007, 2008. They're through the roof. Defaults shot up to 10% on the subprime during that same period. This is the AAA. These are asset-backed securities that are AAA rated. So these are theoretically perceived bulletproof investments that are secured by asset-backed securities. They were trading at a price in January of 2007. They were traded at a price of $100. By December 2008, these are AAA rated securities. We're trading at a 70% discount. I mean, that's an unbelievable swing in valuation. I mean, that's like, there's no model that you get to when you see how bad the market got hit. One good thing, you guys are graduating, coming out, looking for a job today versus 08. Yeah, this is another interesting, let's see where I'm at here. This is another interesting graph, kind of telling you where AAA paper, it was getting basically priced at 50 basis points back in 05. When we got to November of 08, it spiked up to 1,400 basis points. I mean, that's just a staggering number as well. REIT valuation. So REITs, basically, we showed how much growth there had been in REITs. Take a look at 08. They dropped publicly traded commercial real estate that's in the form of a REIT was trading at premiums. All of a sudden in 08, they dropped 50%. So you had a stock that was worth $10, it dropped to $5. All secured by real estate. Nah, generally there's a group out there called the REIT Mafia, and it's kind of, it's definitely funds, but it's a small group that understand that. AEW is big in that, Cohen and Steers are bigger in it, but it's a group that basically has the real estate expertise that kind of tracks it. And there's a lot of individuals that own REITs as well, but I'd probably 30-40%. Oh, no, the CMBS buyers are typically going to be financial institutions. And the REIT buyers are going to be the public market as well as retail. This is a pretty interesting graph. Let me see if I can get to it here. The first one's talking about unemployment. The first, I don't think you guys can read the, so basically from January 2000 to January 2010, there was a net zero growth in employment. So what they kind of say right there is you had an unchanged for a decade of employment that didn't change. If you take a look at January 2004 to January 2007, 8 million jobs were created. If you take a look at January 7th to 2010, 8 million jobs were lost. So we're back to zero, and we had a huge swing in employment between those two periods. Take a look at the bottom graph, what you'll see, which is kind of surprising, retail sales, all of that is December in 2009. So retail sales just plummeted in 2009. Just plummeted, but it's kind of rebounded. Retail sales have somewhat stabilized. People think the worst of retail sales has probably occurred, but there was a huge amount of pain that happened in 2009. You know, those are 4, 7, 6, 8% drops in each one of those months. Here's another interesting graph on the right side. That's people's net worth. So if you take a look at the high, let's look at my notes here. Basically, we lost $2 trillion of U.S. net worth has been lost between 2006 and 2009. Let's admit your stock market's kind of run back up, but we're still net down. We're actually pretty much flat. So basically, net worth's at the same level as it was in 2003. So your parents' retirement accounts, just people in general, are pretty much the same level as they were in 2007 or 2003. Meaning, I think it creates a lot of angst for people on how they're going to retire, what happened to what they thought was their nest egg. This is a thing I got from an economist. There are two main economists in the real estate world. There's a group called Ken Rosen. He's out of Berkeley, West Coast economist, does real estate, focused primarily on real estate. And then there's Peter Linneman, who's out of Wharton. Those are the two big real estate economists that are out there. So this was a graph that he had made in 2008, and what a deep recession would look like. So you'd have negative 2% economic growth, unemployment of 8%, 8.5%. I think we actually went to 9.5%. The stock market, it's kind of interesting. The stock market went to 850. In January of 2007, the S&P stock market was at 1,400. That's the kind of swing we had from the peak to there. If you take a look at the NASDAQ, we're at 2,400 back at the peak. We dropped down to 1,500. Those are huge moves. Kind of impact. Here is the CMBS issuances. There's a couple different financings that are out in the, if you want to go finance a office building, you're either going to go to an insurance company, you're going to go to a bank, you're going to go to a foreign bank, or you're going to go to an investment bank that does securitizations, and you go to the CMBS market. To kind of take a look at from 2002 to 2007, just the U.S. is going crazy. Securitization, typically insurance companies originate or had been originating about $30 billion worth of commercial loans every year. U.S. banks typically finance about $100 billion worth of financing. And then all of a sudden, you see the CMBS market came into the scene in 2002. So now all of a sudden we have $100 billion of bank financing. We have $30 billion of insurance companies. And now we got this new financing vehicle that's adding another $50 billion. I mean, there's a lot of new liquidity that's coming into the market. And by the way, the banks and insurance companies stay about the same, $100 billion, $30 billion. That's their kind of their run rate through this whole period. But then you take a look at how the CMBS market exploded. It basically goes from $50 million to $230 billion by 2007. Let's tell you how bad the market shock was. It went from $230 billion in 2007, and you know what it did in 2008 and 2009? Zero. There was zero origination. Investors got so scared of the real estate market, they wouldn't touch it. Let me tell you what that did to the investment banking world, though. So if you're originating $230 billion worth of product, and you're making about 1.5 points on your money, that's what those guys normally would get paid. That means they're making $4 billion of originating loans. All of a sudden, the next year, $4 billion got erased. So, by the way, when they erased the $4 billion, they also erased a lot of jobs. It was a major hit to the marketplace. This is sales volume. Kind of take a look at 2002, the market through 2007 is just going straight up. A lot more financial, transactions that are more than 25 million. They're at $380 billion. I think that's I don't know what that is. That's a huge amount. And you take a look at the next year, which is 2008, it drops 75% down to 25%. It's doing 86 billion. And then 2009, it even drops more. It's 90%. It's basically dropped 90% from its peak in 2009. I mean, that's a pretty staggering number. If you kind of take a look at 2011, we're kind of back to 2004 levels. 2004 is about 150 billion of transactions. If you take a look at 2011, we're back to 150 billion of transactions.
Which investment banks are the largest issuers of CMBS?
I don't know, probably Wells Fargo. If you look in that magazine, there's probably a listing somewhere in there. It's probably Wells Fargo. If not, it's going to be Goldman's probably ranked up there, and Citibank's probably up there. And again, it's global or U.S. But the U.S. is is 80% of that market, probably 70% of that market. Let's see if I have anything interesting here. If you take a look at the 150 billion that's happening now, what you're finding is most of the transactions that are happening now are REITs are the big buyers and institutional investors, and they're primarily buying gateway cities, coastal, high quality. So it's a core bet that's going on right now, and there's those are the biggest buyers that are buying properties. Are buying urban settings in major cities, and they're paying crazy prices for it. They're still paying 4% kind of cap rates or yields because there are alternative investments. If you invest right now in corporate bonds or fixed income, you're earning 1 or 2%. Your money markets, you're earning 0. So they're making a bet on core, but there's a big problem with that. You're buying at low levels. You're buying at very low caps. More than likely, interest rates are at historically low levels. They're going to eventually have to move back. Cap rates are going to have to move out. So you're going to have a lot of income growth to make up the difference in the cap rates in the future. So I actually think it's a fairly risky bet that the institutional money's chasing core as hard as they are. Okay, resurrection of the dead. What happened? The government stepped in. They played a very active role in putting liquidity back into the marketplace. They basically, Fannie Mae and Freddie Mac, AIG, major insurance companies, Citibank, they increased, it was $100,000 FDIC deposit insurance. They increased it to $250. They pumped worldwide. We had $1 trillion of new financing pumped into the banking system. We heard of TARP, which was the government assistance to help the banks. It was a $700 million investment that they plowed into the banking system. They purchased, so they forced banks to take $250 billion of preferred equity. The government actually forced banks to take their capital, and they took an ownership position in a lot of banks. I'm not quite sure that I think in reality, from an investor perspective, it probably was a smart thing. It gave the market more confidence that the banks were going to be around. I'm not sure the policy was great, but I think the outcome was probably worked. Also in 2009, what happened is all of a sudden people were earning 0 on their investments, and they were looking for some way to get their money to earn an investment, and they started looking at the public markets, started coming out with securities that they were issuing, and the public markets or investors were saying, you know what, I want to invest in these great names. These are all very strong real estate companies, and if you kind of take a look out here, the average yield on buying these securities, these are unsecured securities backed by these publicly traded companies, was 8%. So that's a huge yield to be paying on a rated security or unrated security. So again, 2009, the public markets came back. By the way, we did talk about this. So REITs dropped 50% in value, right, in 2008. So they got whacked. All of a sudden, the operators of those REITs went back to the public market because they needed capital. And the market said, you know what, I'm going to give them capital because I think they can buy real estate really cheap now, and I can earn a great return. And that really kick-started the real estate market coming back. If the investor market hadn't come back, that's what really restarted the market. This was basically mid 2009. The REITs came out, they did IPOs, and the market was there to support it. And the market was looking for a way to earn a return, and they believed in these good names, and they also thought the market had bottomed out. So we had liquidity coming back into the market. Well, you know, it's kind of interesting. The idea was, I think the idea was, is real estate's cheap. We want to give these guys money. They're going to go take advantage of it. In reality, what's happened is the REITs have done just the opposite. What the REITs have done is they are been big buyers of New York City, Boston, D.C., Miami, L.A., San Francisco, the big urban core markets, and they're buying kind of at very low cap rates. And the markets, the investors have come back and have rewarded them for doing that, even though the initial flow was to take advantage of cheap real estate. And what they've done is they said, you know what, we think it's too volatile out there. We'd rather be invested in high quality assets and earn a 4% return on our money rather than having it in a money market earning 0. So they've kind of looked at it and said, on a risk adjusted basis, we're okay with a 4 and we want higher quality assets. Matter of fact, the REITs right now are actually selling secondary assets in the marketplace and trying to load up on gateway city assets. No, I don't think so, because if you go back and you look at the names here, you know, Simon Properties doesn't own properties in Wichita. They own big malls, high quality. So I think they thought these guys are good stewards. They're going to find good deals, and we trust them given we're at the bottom of the market. I don't think they said, hey, we're going to go steal, you know, some little shopping center in Gainesville. And,
it wasn't just in trusting them to make the right acquisitions. I mean, they're equity backed in, but the market demanded to recapitalize themselves. Their LTVs got, their leverage had gotten too high. And investors said, look, you guys, your loan to values are too high relative to standards. You got to recapitalize your balance sheet. So I don't think it was just that that the market thought that they could find good places to invest the equity. I think that they needed to repurpose their balance sheet by raising.
yeah, but the investor that was giving them the money, that was putting the money in, didn't care that they were over levered. They put it in because they thought it was a good investment, right? You think guy was going to put good money after Met? I think for the most part, I think number one, if you take a look at this slide, I think what happened in the market also was guys were looking. There was a cap rate. All of a sudden, cap rates were going. Guys were buying properties that are 6 or 7 cap, and all of a sudden, caps were going down to 4 to 5 on high quality assets. So they were able to have an arbitrage on cap rate, even though the income was the same, and they were able to deleverage their portfolio. So that the purpose for the guys that were going public was an opportunity to deleverage their portfolio. Okay. I'll have to fix my chart next time. It also happened in the on the debt side. There were mortgage REITs that went out. Actually, all these mortgage REITs that set up, only one of them actually went out, which was Starwood. Actually, the market pulled back. The market did pull back on the IPOs, and basically they shut the IPO market for mortgage REITs. The only mortgage REIT up here that got done was Starwood. So it was very short-lived that happened. There was a 6-month period, and then the public markets closed. Which, if you kind of take a look at what happened in 2010, right? All right, this is 2009, what the status of the debt markets were. You know, number one, this is a good number. The size of the debt market, commercial market, debt market in the U.S. for real estate is about $3 trillion. You know, so if it's a 50% leverage market, it's a $6 trillion real estate market. see what I got here. Also, 2007, basically, the banks still didn't have a lot of, there still wasn't liquidity coming out of the banks. And a 7, take a look at the equity markets, and again, 09. Prices dropped 50% by 09. They recovered a little bit. There probably was a 10 to 15% recovery on price. Cap rates at this point were widening. One also thing that happened in 09 is that's really when the special servicers assets were getting transferred from the master servicer to the special servicer for CMBS loans that were going bad, and they were basically getting $3 to $4 billion worth of assets were getting transferred on a monthly basis. So on a given year, you could have $36 to $48 billion worth of real estate assets being transferred over to special servicers. Now, right now, if you take a look at special servicers, they're sitting on about $90 billion worth of commercial loans that are having problems. And this is the year that it kind of kick-started. If you also take a look at also 09, that's when that $20 billion of REIT equities were issued. Moving on to the current market, which I think is probably more important. If you kind of take a look at just some themes that are going on is, number one, Europe last year, Greece last year really created a lot of concerns in the U.S. There's still some concerns about Europe, but I think the overall feeling is that Europe is stable enough that the U.S. can kind of ride that out. There's not a double dip recession. Europe's not going to drag us down. There's more stability in the U.S., and a lot of that is by the thought that Europe is somewhat been stabilized. Next big question is, we have very low interest rates. What's driving that? Is that Fed policy, or is that just the global risk concerns that are out there? I think it's probably a combination of both, and I think that's a big concern, is how long can the Fed artificially keep rates down? Bad things happen when you artificially do things, and keeping rates down where they are, all of a sudden it's going to make it easier for your debt coverages to work. We're going to end up back in the same problem. Same issues are going to occur from an underwriting perspective if we have low rates, because eventually they're going to come back to some type of historical mean. And the last bullet point is a pretty good one. The U.S. pension funds and the global pension funds and the whole world has been kind of working on that we have to earn 7% on our money to be able to meet our obligations over time. If we want to build a nest egg for retirement, and we want to meet, we've got to meet inflation. 7%'s always been the bogey. Right now, we're sitting in an environment where it's very hard to put your money anywhere and earn anything that's close to a 7% return. So the big question is, how do we deal with not being in a 7% earning environment? And also, there's got to be a significant amount of fear of inflation when you're artificially holding down interest rates like that. This is pretty interesting. If you kind of take a look at what's happened over the last 12 months, the S&P is up, but the volatility has dropped dramatically. So it's a much more stable environment that we're currently in than we were. Before, that volatility index over 2008, 2009, 2010, it was all over the place and mainly going down, not up. This is if you take a look at the forward curve, so if we're looking at the 5-year and the 10-year treasuries, and you look out 36 months, it's pretty much flat. The belief is out there is that the Fed is going to keep rates down for an extended period of time. And again, there's positives out of that, and there's a lot of negatives by doing that. Oops, let me go back here. This slide right here is kind of telling you what the difference was from treasuries. Treasuries have remained pretty much flat or actually down. If you look at it over the last 6 months, there's been some movement. It's been moving down. And then if you take a look at the forward curve, you'll see that it's got the 10-year treasury at 270 3 years from now. It's currently just under 2. So relatively flat over that 3-year period. This is kind of an interesting graph. If you basically had $100 million to invest and you stuck it in 1-year treasuries, you make $0 on your return. If you stuck it in the 5-year treasuries, you make $750,000. If you put it in 10-year treasuries, you make about $2 million on your money. If you did AAAs, about $3 million bucks. And if you bought core real estate at a 7% return, you'd make about $7 million. So it's kind of pointing towards, there's really no place, there's not a lot of places you can put your money that you can have a decent return. Real estate does look pretty attractive in this environment. U.S. REITs, if you kind of take a look at from 2010 to present, the last 12 months, the REIT market has been on fire. It's been up. It's sold off a little bit this year, but it's up 48%. If you take a look at the NASDAQ, it's up 23%. The S&P about 18. That's a 24-month period, so you divide it by 2. That would tell you what your annual kind of returns would look like. But the REIT market's been pretty healthy. You know, I have a graph that shows that cap rates have dropped on average. Now it's taken real estate all over the country from a 9 to a 6, 7. That's kind of where, yeah, that's kind of. I'm going to skip through some of these just because they're, let me see if I can find something that's. And if you wanted to take a look at where, if you went out and you try to finance a piece of commercial real estate that was decent quality right now, and you went to the insurance companies or the CMBS market, and you were getting a fixed rate loan or a floating rate loan, and if you were looking to do a 5-year loan at 50% leverage and 60% at an insurance company, it's probably going to cost you 3.7 to 4% between that 50 and 60% leverage. If you were to go to the CMBS market will finance you more. You typically wouldn't go there because they need a certain return unless you wanted 65 to 70% leverage. It's probably going to cost you 5.25 to 5.5% on a 5-year basis. And if you did floating, based on that, that's what it would look like as well. So still a very, typically historical, financing market, somewhere probably more like a 550 to 650 is historical rates. So we're looking at a fairly attractive environment to borrow. This is kind of just showing you, we basically had that huge drop in the REIT market. You had a 50% drop in value. You're kind of seeing that it's popped back up, it's positive, it's moving in the right direction. So this is from comparing publicly traded real estate to the private sector. This graph right here is just trying to tell you that the REITs in general are sitting on, they have about $80 billion worth of purchasing power right now. So they're pretty flush. They definitely got cash. They will continue to be net active buyers. If you take a look at the whole banking system, which is the banks, the insurance companies, CMBS and other, and you look at maturities, it's about a $300 billion plus market of maturities that are going on every year from 2011, 2012, 2013. So for the most part, the most aggressive loans were probably written in 2007, right before the crash. And most loans at that time were primarily 5-year loans. So the loans that are maturing in 2012, by definition, are going to be pretty aggressive and over-levered. So within that $360 billion, if you kind of take a look at my number that I was telling you before, insurance companies are estimated to do about $50 billion of originations this year. They historically have been around 30. They've started to move up because they can take advantage of the market. And you take a look at the banks, they're around 100, 120. And you take a look, CMBS is kind of projected to do 50. So call it, we have about $220 million of financing out there, and we got $360 billion coming due. So we got a problem. There's going to be, now, if you kind of take a look at what the U.S. governmental policy has been, is kind of to give these banks a lot of freedom to do what they call extend and pretend. They're probably going to continue that policy of allowing a majority of this stuff that doesn't get refinanced to get extended out and hope that the market rides itself back up. Problem is, we got the same amount maturing next year. And we got the same amount maturing the next year. So at some point, we're going to have to stop that policy and deal with reality and mark these assets to market and let them trade like a normal free market would work. I'm not a big believer in the policy that we have because I think we end up with buildings that are zombie buildings. Meaning, if I own a $100 million office, if I own a building that has $100 million worth of debt, but it's only worth $80 million, it's hard for me to go write leases that don't support the amount of debt that I have on the property, because if it doesn't support the amount of debt, then the money I put into it doesn't ever come back to me. So these are called zombie buildings. So eventually these assets are going to continue to deteriorate because nobody's economically incentivized to keep the asset value up. So, you know, we got this policy going, and at some point, the day of reckoning is going to happen. You know, you can't. The U.S. economy is built on a marketplace, and by allowing these banks to sit on these assets and not keep the asset value up is going to, at some point, they're going to have to leak out, and they're probably not going to be worth the same amount that they're worth today, 2 years from now, without having any capital invested in them. This is the graph that I was talking about on the special servicing side. These are CMBS loans that have gone bad. So if we kind of take a look at, it's pretty flat. It's kind of bottomed out. In August of 2010, there was about $90 billion worth of bad assets that were held by the special servicers. There's currently $83 billion, so it's starting to taper down. But there's still a lot of assets that are impaired, that are still in the system. It's kind of a misnomer, though, when you say 80 billion, because what is the 80 billion? So if you kind of take a look at this slide, there's 83 billion. There's half of it is what we call 90 days in foreclosure or REO. Those are really the troubled assets. So, you know, half of that 50 billion of the 83 billion are really tough assets that they're going to have to work its way through the system. All right, now we're going to, this next graph is with a handout that you guys have. And I think this is just kind of important to know that I think if you guys are getting ready to graduate, getting ready to go out there, there's different types of places where you guys can end up. You can work for investment banks, you can work for owner-operators, you can work for asset management companies, you can work for the street, you can work for securitizers. There's also the advisors that are out there. And the thing that I like about working for an advisor or working for a broker or working for an East Hill Secured or CB is there's tons of transaction flow. They're selling real estate. They're arranging financing. It's really a great place to get broad exposure to the commercial real estate world and then kind of gravitate what you like. I think it's a good place to go to really get exposed to real estate from a lot of different facets, and it's probably the broadest. And this kind of just gives you a little bit of information of where they're located regionally, what property types, who are the big players. So anyway, I thought that'd be a helpful handout for you guys. Next thing, there's two other things that I brought that I think you guys have out there. Is a thing called the Commercial Real Estate Alert. This thing right here, and this is a special edition, and it kind of lists there are operators out there that go to pension funds to borrow money, to do joint ventures with, and there's approximately 360 of them out there in the United States. And they're currently about $240 billion they've raised from institutional capital to put out into the marketplace. And they can either be opportunistic investors, they can be added value investors, core investors, but these are where the big players in real estate are these guys right here. So there's in here, it's got a listing of who these companies are, how much capital they have. I think if you dig down in here, there's actually some names and numbers of guys to call. So anyway, this is who's who in the real estate world that's got big capital and that are big players. This magazine, which is called, does a weekly publication, and it's really a great publication because what it does, it tracks transactions, real estate transactions, who's doing them, who's selling them, what they sell for, who's getting hired for people. So I think I'm not sure I gave you a copy, but somehow if you guys can if you know people in the real estate business, call them up and ask them to email them to you. It'll keep you pretty current on what's going on, especially on the real estate side. There's also one called Commercial Alert. Commercial Alert tracks it from the debt side. What properties are getting financed, what banks are doing the financing, what the rates are. It's a we call this trash magazines. This is kind of like the gossip thing you get at the grocery store, on the real estate world, and it's pretty useful. There's another one that I brought, which has the rankings of who are the big investment banks that are selling assets, and I think that's out there that kind of tells you. I think the one that I brought was for office sales, and it kind of lists who's selling what, and what regions are the strongest in. I think those are pretty good things to, at least if you guys are interviewing, I'd read through them, be kind of tight. I think they make you fairly current on what's going on. The last thing I brought is, there was a deal that I chased about 12 months ago, and it was a $300 million portfolio of assets that Wells Fargo was selling. Wells Fargo, I don't know if you guys know, bought Wachovia, and they assumed a bunch of real estate, which were primarily CMBS loans from Wachovia. These weren't, those were perceived as really bad assets. Wells Fargo has a very good reputation of being a relationship lender and doing high quality real estate. So this happened to be a portfolio of assets that Wells Fargo had originated. So this portfolio came out, it was $300 million, it was 22 loans, it was $100 million of hotel assets, it was approximately $100 million of office assets, and it was $100 million of multifamily assets, in broad terms. It was located in 12 or 13 different states, and I kind of looked at it and said, I really like this portfolio. It's number one, it's high quality assets, high quality borrowers. It was recently built, 2005, 2007. These were bank loans, so they had guarantees on them. It was big enough that most guys wouldn't have the wherewithal or the manpower to get their hands around them. So I thought it'd be a great portfolio to go after. There's a couple problems. It was $300 million. I don't have $300 million. It was a short time frame, and I had to have a better mousetrap than somebody else to figure it out. So first thing I did is I said, how am I going to understand, how am I going to get my hands around 22 assets? And this got offered in a 10-day period. So you had 10 days to underwrite it, put in a bid, and theoretically you were supposed to close 10 days later. So first thing I did is I said, hey, I got to figure out how I can be smart and really understand this portfolio. So I like hotels. I think during a distressed market, great asset class to go after. So I called up a good buddy of mine that has a hotel management company, fairly good size. I said, why don't you join my team? I need some hotel expertise. You put in some of the money, I'll put in some of the money, and I'll find the other capital. And I basically did the same thing on the office component. I did the same thing on the multifamily. So I went and found really smart people that were located in those markets that could allow us to access that market really quickly. Then I also went to, I had to go find the capital. So I went and found, out of that handout I gave you, there's 400 guys to choose from, and I have been in the business for 22 years, I have some pretty good relationships. So I found a capital partner that basically was willing to be the majority of the capital to line up with me. Whenever you go after one of these deals, you got to bring the capital with you, because if you wait and do all the work and then sit down with them, they just tell you how bad you did the underwriting. So it's always better to bring them in right alongside you and let them do the hard work with you, because they'll second guess you a lot less. And then the other thing is it's $300 million. It's a big portfolio, so I had to figure out how to finance it. If I was able to bring financing, that generally adds about 300 or 400 basis points more return to the investment. So in a competitive world, if I can bring financing, I can pay more than somebody else and still earn the return that I want. In an uncompetitive world, I can pay less and earn more because I can finance it. So it's always advantageous to finance it if you can, as long as you don't believe it's putting you in it. You don't want to be over levered. You want to basically do it at an appropriate level. Because I kind of talked about what was attractive about this. One of the things I also like about pools of assets is you got diversification. You're going to make mistakes. If I buy 22 assets and I make a mistake on an asset, I can absorb it. If I buy one asset and I make a mistake, it's more painful. So diversification is a great thing. I think as we learned from securitizations, though, it better fundamentally work, because being diversified doesn't help you if it's not sound underwriting. This was the team that I put together. I went to Prism Hotels. I brought in Provident, who was a multifamily expert, Continental Companies, which are graduates from University of Florida. They're located in Miami. They got 12 million square feet, big concentration of Florida-based assets, brought them as a partner. And then I went to 5 Mile Capital, which is a $1.5 billion equity fund to be the big capital that came in, and then I thought of a smart thing. I said, why don't I go to Wells Fargo and see if they finance me? Even though they were selling the asset, I went to the other side of the bank, and I got them to agree to finance me. And they were like, I don't know if we can do that. And then they said, you know what? We already know the assets. This is great. I'd love to do it. So they agreed to finance it. Negative is I ended up losing this transaction, but I thought it was an interesting transaction to kind of run you through. Here's what, when you go after a loan portfolio, these are non-performing loans. So you're not buying the real estate. You're buying the note. And you don't really control whether the borrower is going to pay you or the borrower is not going to pay you. You basically have to underwrite it assuming you're going to fight the guy and you're going to have to foreclose the asset out, and two, he may pay you off. So you better be happy with your pricing under both scenarios. So you really have to underwrite it two different ways. You have to write it under both scenarios. And once you start diving into it and you try to figure out it's a $100 million asset or a $50 million asset or a $10 million asset, but it's only worth $5 million, you're probably going to get the asset. It's so over-levered, it's probably going to be a non-performing asset. You're going to get it. So as you do the underwriting, you'll come up with your scenario that's highly likely. In some cases, though, I just bought a $20 million shopping center loan on a neighborhood shopping center in Scottsdale last week. And it's a tweener. It's got 2 years till it matures, and the market's improving. And I was like, you know what, this thing may be a performing loan 2 years from now. Right now, it looks like it's underwater, but I underwrote it under both scenarios, and the return's pretty attractive. So we look at it both ways. So when you're buying loans, you got to look at it both ways. You have to be able to understand how to underwrite the loan side of the deal as well as the real estate. So what do you have to do when you're evaluating? Let me show you this asset. So this is one of the assets that was in the portfolio. It was a 4-story newly built office building, Miami, 123rd Street and Biscayne Boulevard. Demographics around it are through the roof. It's high net worth. All the decision makers that work in downtown Miami live right around this place. And this is a high-end office building that just got built. It's the only one in the market. It's kind of like, you know what, eventually guys aren't going to want to drive to downtown Miami when they can come here. So eventually this thing's going to work. It's just over-levered. So when we attack this, you basically have to be able to read loan documents, interpret what they say, whether you really have a good guarantee, whether it's an enforceable loan, whether you have a good title to the property. You also need to underwrite the real estate. You have to figure out where the current income is, where do you really think it can go. So by teaming up with the Continental companies, they're real estate experts, office experts in that market. They can tell me that my retail is, first of all, that market demographic supports retail. It's a great retail location. The big question was, are we really going to get to see the decision makers to office here and lease it up? It was 50% occupied. And then the demand is, there's too much demographics around it for this thing not to work. It was just over-levered. So you also have to look at the underwriting, the financial side of it. What do the numbers support? And they don't have to support the loan. They have to support your price. That's the other thing they have to look at. We also talked, the fourth point is, again, you have to look at, is this a performing loan or not a performing loan? Is it a sub-performing loan? And you have to figure out how you're going to value it. And you end up with, when you value these things, you have two things you're looking at. A loan may be performing, and it's just over-levered, and it's in a default at the maturity date. So if I buy that asset, I'm going to just get the payments off the loan. Even though the property's got the cash flow here, the guy's just going to keep making me the payment, and then at maturity, he's either going to pay me off or I'm going to foreclose him out, and then I'm going to get the property cash flows, and then eventually I'm going to sell it. If it's a loan that's in default, I'm going to have to get a receiver in. The receiver is going to manage the property until we litigate and we get the property. So I'm not going to get any cash flow until I foreclose them out and get to the property. Then I got to take it over. I got to own it for 3 or 4 years and stabilize it. And then I'm going to sell it, and then I got to discount those cash flows back. So you have the loan cash flows, the property cash flows, and then the most important cash flow is what do we get as the investor? What's that cash flow look like? And then you discount that back. And you can discount it back one or two ways, unlevered or levered. They're typically non-performing loans probably are getting priced at a 12% unlevered return. You can kind of finance it. You're probably 15 to 17% kind of returns. The problem with debt, when you buy debt, it typically is only a 3-year hold. So most people like multiple, meaning you buy an asset for $10 million, you sell it for $15 million, you make 1.5 multiple. Most people that buy real estate want to earn closer to a 2 times multiple. People that buy debt, it's not, you can't make 2 times multiple, very difficult. So there's kind of 2 different mindsets depending on your investor capital of what you can deliver. Well, well, no, I think, for instance, for instance, I bought an asset in Fort Lauderdale, a medical office building. We bought the asset, and it's a good-sized fund, institutional fund that owns it, Middle Eastern money. Guy says, hey, we'd really like to figure out how to work a deal with you. I said, fine, well, why don't you propose a deal for us? And if we can work something out, it'd be great. So he comes back. He says, my capital wants to earn 18% on their money. I said, well, my capital wants to earn 18% on my money. There's not enough money. There's no way to make it work. So the answer is yes, you try to figure out how to get a deal done. A lot of times, maybe a loan is over-levered, but it's close, and you'll cut a deal with the guy, say, I'm going to give you an extra 24 months, and you restructure the asset, or you say, you know what, there's equity value here. I'm going to give you a loan, a high-rate loan. If you pay me 15%, you get me my return, and it's your property. So you're always, the worst thing you want to do is litigate. You don't want to go into a bankruptcy. You don't want to force a foreclosure. You're trying to figure out a way to. Yeah, and this pool was a wealthy family. There was no way they were ever going to give us back this asset. So on this one asset, we didn't think there was ever, it was so over-levered. The Causeway, we didn't think. A lot of times, the one I bought in Phoenix, it's 50-50. I think it's 50-50. So I analyzed it under both scenarios and said, the guy pays me off, and I bought it at this price. I'm going to earn a pretty attractive return, and I'd rather own it, but I don't have to. Let's see what else. Okay, so this Causeway. It's a good-looking asset. Here's an interesting thing. So it turns out this has an LA Fitness in it. The whole second floor is LA Fitness. Problem with LA Fitness is they're the second floor and they got all these weights. And all the bottom floor was empty. It was because of all the sound, the weights dropping and stuff. So basically on this evaluation, I'd assume we spent $150,000 re-insulating the floor so we could get some tenants in the first floor. So that's just one of the things that's why it's always good to go see the property. So this asset we priced to a 15 levered and a 165 multiple on a 3-year hold. All right. Can't believe no one fell asleep. That's all I have. Any questions? You know what, you better go look at the properties because you'll find, there's property inspection firms that are out there. Ideally, you go look at them. Sometimes they're a big portfolio, you can't get to them. What you want to do, let's say you're looking at call it a $100 million portfolio or a $500 million. You better go look at a big percentage of them. You better go look at 80% of them. By the way, look at some of the small ones too because those tend to be the worst ones.
Did you get to all those properties?
Yeah, we looked at all 22. I couldn't have done. There's no way I could have done it without reaching out and finding people in those local markets to do it for me. And the other thing was, I think we all learned our lesson. When you don't have money in the game, you probably don't care as much. So I made every one of those investors, all those operators, invest with us. So, yeah, I think real estate is definitely location. So seeing them, and then also, these are distressed assets. I mean, guys could be, people do weird things. Take the plumbing out. Miami is definitely a beneficiary of foreign capital coming in, and it definitely, who would have thought 24,000 unsold condos would get absorbed, right? Who would have thought the amount of hotel rooms that Miami built would actually, I think Miami's a top 4 or top 5 hotel market in the country, you know, and it was overbuilt. If you take a look at what happened in 1990 recession, it took 10 years for the condo market to get absorbed. Give you an example. San Diego, very nice market, got overbuilt with condos, only had 4,000 condos. I mean, it's a bigger market than Miami. So 24,000 got absorbed. So yeah, I do think Miami's been the beneficiary of it. I don't know. I kind of look at prices. Prices haven't gotten stupid. I think things cratered down to $400 to $500 a foot versus $1,200 a foot. So I don't think. I think the money came in quicker than you would have thought, but I don't think prices got pushed up to a crazy level. Other than I did hear the W's now starting to trade around $1,500 a foot, which I was kind of. I think, you know, I was there, and it's really nice, but they may get 10 sales, but they're not going to get 60 sales at that level.
So given that core has been kind of the hot market of late, where do you see the market kind of shifting to? And then can you describe the properties that would be within that investment opportunity?
I think that, you know, I think the suburban market's gotten hit really hard, and you know, my sense is there's really a move into urban markets. I don't care whether you're in Fort Lauderdale versus out in Weston, but there just definitely seems to be people are looking to be more in the action. But it seems like the suburban markets have gotten penalized really badly, and the smart money, the Blackstones of the world, are buying suburban markets now. The Brookfields of the world are selling their. These are smart guys. They're selling their core assets to those core buyers and reinvesting in those markets. So I think you're starting to see smarter, opportunistic money trying to figure out how to buy in places they get a better return. You know, you're also seeing like a Blackstone buying industrial portfolios, which appear to be high prices, but at the same time, it's wider than historical levels. And I think what they're doing is they're doing a big accumulation to do a public exit, which kind of makes it a little bit different. So you know, I definitely think you're starting to see money now starting to try to figure out how to make more return. I also think the institutional guys got burnt so bad. You know, it's kind of like, I don't know, it's like me. I got my, you know, 2007. I sold every stock I had because I couldn't take the pain. And I think institutional money was like that. And you know, they want to go back into real estate, but they want to buy something that looks good and that they believe is not going to go down. And I think the more opportunistic money is starting to figure out how to be a little bit more nimble.
I was just going to ask your opinion on REITs that invest in both agency and non-agency RMBS. A lot of them are trading at really low valuations and have extremely high dividend yields of 14, 15, 16%. I was just wondering if you had any opinion on that.
You know, the other thing I would say, when you see 14, 15, there's more risk. The reason why it's trading at that level is there's definitely a lot of embedded risk. You know, I don't know. In 07, I gave a bunch of money to Cargill to buy residential, and it was way early, and I still think it's, I think right now there's a big move to buying single-family homes and renting them out, and I think that's a great plan. It's really working, but I just don't know what you get out at. So it's like, hey, if I like a 6-7% return, it's a good investment, but if I want a 18% net return, I don't know what to put on the end number. So I just don't know. I don't know how long it's going to take the U.S. residential market to recover. You know, I also think there's a big, people are just guys like you. I think you're thinking, you know what, I don't really need to own a house. You know, it's pretty. I can rent. I don't have to put my $20,000 I got in the bank into this investment. I think there's a mindset changing. I think if you kind of take a look at, you know, I think we almost got to 70% home ownership, and it's down less than 65%. I think, you know, it's probably going to continue to drop. You know, we had really, so if you looked at 09, 010, if you try to get a loan, like I refinanced my house, I'm about as good as you can get, or at least to go to a bank to get a loan. And it was like the documentation is like, you know, they want every K1. It was relatively difficult. I think the banking system makes it hard for the average Joe guy to go get a loan, and therefore that availability hasn't been there. I think it is improving. And I do think rates are going to stay low for the next 2 or 3 years, and we'll see more money coming into the system to the guy that does want to buy the house. And it's probably, you know, it may be early to buy a house, but you know, at those kind of rates, you know, if you can borrow, you know, if you can refinance at 3, 3.25, that's pretty attractive. And I want to buy as many assets as I can because I don't think I can borrow at 3 and 4% ever again. So I'm trying to, unfortunately, I'm not the only guy chasing stuff, and people, in my opinion, are paying too much. But it's like this is a great time to own a hard asset.
Do you think it's a strict underwriting standards that are releasing the rates now?
No. I think it's the U.S. government. It's the Fed. The Fed is pushing down rates. I think, though, that could be a problem because guys are paying 4% cap rates for quality assets that is not an historical sustainable cap rate or an interest rate environment. Rates will go up, cap rates will go back up, and they're going to be kind of mixed. They're going to be in these assets. Unless you have significant income growth, they're going to be out of whack. And by the way, the multiple, you have to have a lot of income growth to make up a cap rate adjustment. It's almost impossible. Unless you have a 10-year hold. A lot of these guys are institutional investors that can hold the asset for 10, and maybe we get great inflation, and all of a sudden, because they have a 10-year horizon to hold it, maybe that works. If you're buying for a 3, 5, or 7-year horizon, I think there's a lot of risk. Yeah, well, we had 3 different property types. We had multi-hotels, and we had office buildings. Generally, the methodology is buy the investment, work it out. When you get title to it, how long does it take you to stabilize it? When you stabilize it, sell it. And that generally works out. The average hold period, depending on the asset, was somewhere between 30 and 48 months. It's probably about as long as you could hold that asset. Sometimes it makes sense. A lot of people want multiples, so if I can figure out how to stabilize the asset and hold it and grow my multiple, sometimes that makes sense. Sometimes it works and it doesn't work. Kind of depends on what's going on with the cash flows. But generally, generally when you're buying non-performing assets, it's a 3-year hold. It's going to be 24 to 48 months. And you're going to average 3 years. And when guys buy equity, when they buy an office building, it's generally a 5 or 7-year hold. And that's why the multiples are bigger. But with debt, unless you want to buy something, work it out, and then just hold it because you want to. But the problem is your returns start going down. It's like you maximize it, you're kind of flattening it out, and the time value of money reduces your returns. And they pay a guy like me to pay him more return, and now they want to hold it. So you're not aligned. You want to go back to that graph? Okay. Well, I know one thing for sure. I told Dr. Archer that he was supposed to point out any mistakes I had, and I told him if he didn't point anything out, it was because he was being polite. I haven't heard from him. Yeah, that's a good question. I think humans, for whatever reason, people tend to make the same mistakes over and over again. So in 2000, so when would this have been? 2011, the CMBS market kicked back up. And I bought a office building, which is called a post-production office building, which is in LA. This is where like a Larry David films Curb Your Enthusiasm, and after he does his all his filming, he goes in there and he edits it. And what happens at a post-production facility is about 30% of the square footage is occupied by the Larry Davids of the world, that the big name guy, whether it's Michael Mann. I mean, that would be another one of these tenants that was there. And they kind of basically they occupy 30% of their space, and that's where they have their office. And then when they're working on a project, they need space for to do their editing. So they want to swell up. And there's not a lot of space in Santa Monica that allows you to do it for certain restrictions, so this was like one of those few buildings that does it. It's called a special purpose property, right? This is a post-production. People like long-term leases. They like credit. Great assets. Underwrite's phenomenal, but it's a special purpose asset. The CMBS market just kickstarted in like November, December This was a January deal. I ended up getting 7 conduits to quote it, to provide me 72% leverage. And I mean, it was a food fight. And it was an asset class that really doesn't fit in, special purpose assets typically by definition shouldn't be in a conduit, but I mean, the market was right back to doing that kind of deal. So I don't know, that kind of gave me poise that, how much do people really learn? But I was a beneficiary of it, so I kind of liked it. So I think that at the end of the day, the problem with the CMBS market is the people that originate the loans don't have to hold any. So therefore, it's really about how much can I get through other people versus I got an economic risk. So I don't know, I'm kind of twisted on it. I don't think the investment banking world is really set up to hold 2 or 3% of all their securitizations. But at the end of the day, because they don't hold anything, I think they will do whatever the market will bear. So I also think there has been some changes where in the documentation where the control rights are changed that make it a little bit more safer for the investor. So I think there are changes that are going on that are improving it, but I don't think it's been written yet. I think the bigger banks are more sophisticated and they do a pretty good job of processing it. And I think the smaller banks, the little community banks out there, probably did the most risky stuff. I mean, they're doing primarily the community banks were doing primarily development and construction, which is probably the riskiest, and they're probably really not set up for it. So it's kind of a catch-22. I think we don't want to be dominated by 10 banks. I think at that, then I think whenever you have a monopoly, you're going to have a problem. But I think we have to be a little careful not having a bunch of small banks trying to do sophisticated things in their own backyard. I think they end up with no diversification either because they're kind of limited to where they can go. So I think we need medium-sized banks and large banks.